The yen is the weakest G10 currency, falling against its major peers this week. The yen fell yesterday and extending those losses today, albeit at a lesser extent, after coming under pressure following an earthquake in northeastern Japan on Monday, which briefly raised concerns about economic disruptions. The earthquake measured 7.6 on the Richter scale. However, tsunami warnings have now been lifted. The downward revision to Japan's Q3 GDP also weighed on the currency, supporting PM Takechi's stance to boost growth, whilst also complicating the outlook for the Bank of Japan. Now, the Bank of Japan will meet next week, and they are expected to raise interest rates amid a gradual plan to normalization. Whilst recent hints towards a rate hike from BOJ Governor Ueda have helped the yen recover from an 8-month low versus the US dollar, the yen still trades around 5% lower since the start of October, pressurized in part by PM Takechi's huge spending plans, which have sent Japanese bond yields to multi-decade highs. I think any meaningful recovery in the yen is going to require not just the Bank of Japan to hike rates, but also to follow through with stronger than expected guidance and also plans for policymakers to demonstrate fiscal prudence. The weakness in the yen is potentially more evident against other yen crosses. The Japanese yen is trading at a 16-month low versus sterling, a 35-month low versus the euro, and a 17-month low versus the Aussie, particularly following that hawkish RBA hold overnight. So a dovish hike from the Bank of Japan next week, combined with expansionary fiscal policies from PM Takechi, could keep bond yields elevated and keep the yen under pressure heading into 2026.